Hello. Now, the second element of or condition that must exist in financial statements in order for them to be truly useful to investors and creditors, and again, let's make sure we've got our focus here. What we're talking about is financial accounting, the process of trying to create information that investors and creditors can use in making investment decisions intelligently. And we said that they need information, and that in fact that information it would be better if in fact it's governed by common rules of accounting to create comparability. But even if in fact we're using common rules, what if in fact the numbers that are in the financial statements just aren't right? See, these financial statements, in order for them to truly be useful to investors and creditors, not only need to be prepared in accordance with some generally accepted accounting principles to create comparability, but it also has to be accurate. Credibility refers to the need for the financial statements to provide information that is materially accurate and reliable. Now, who is it that really prepares the financial statements and determines the amounts that will appear on that? A company's management is responsible for its accounting system and the preparation of its financial statements to be distributed to the public. The problem is that management may have conflicts of interest in the accurate preparation of those financial statements. In some companies, members of management are also shareholders. That's not necessary in all cases. But it is true that there are some, members of management that may not own any interest in the stock. But isn't there some kind of a conflict of interest, really, if management is responsible for managing the business and they also own stock? I mean, wouldn't you, if you were a manager and if you, had some questionable ethics maybe, say to yourself, what I think I'll do, let's make the financial statements look really good this year. Really good. That way the value of the stock will go up because people will think, wow, the business is doing so well. And maybe we'll even get a bigger bonus, in terms of our compensation, because people will be so impressed with our business. And then we'll sell the stock at the high price. And when everybody discovers that maybe the company wasn't doing so well, hey, we'll be gone. I mean, some people have actually got involved in businesses and seen the businesses not maybe performing as well as it should be, but wanted to actually falsify that information in a way to impress potential investors and maybe have them so that they could sell their stock and then move on their way. So management is responsible for preparing these financial statements, but they may have some conflicts of interest. Materially inaccurate financial statements are at best worthless, but at worst they may actually deceive investors and severely damage the users of those financial statements. As a result, the Securities and Exchange Commission, which is the government regulatory body that's designed, that's been established really to try and regulate capital markets and protect investors and creditors, they require that all financial statements of the publicly held companies over which they have jurisdiction be subject to outside independent audit for accuracy by an independent certified public accounting firm, a CPA firm. A CPA is someone who has certain professional credentials and experience such that they can come into a business, take the financial statements that have been prepared by management, and perform some tests, some audit of those financial statements to try and verify the material accuracy of that information and that in fact they have been prepared in accordance with generally accepted accounting principles. The CPA will issue an auditor's report that must accompany a company's financial statements, and clearly state the material reliability of the information and its compliance with generally accepted accounting principles. Let's kind of take a moment here and summarize what we're talking about and really the key players in this process. What we've been talking about are businesses seeking to access capital. And again, you may be involved in this picture in your own personal lives, in that you may be, part of a business, starting your own business, or part of a business that needs capital and is seeking that capital by borrowing it or from investors by effectively through issuing or providing ownership in your business through the issuance of stock. You may be participating through companies that are trying to access capital in the market, or you may actually be involved in the standpoint of an investor thinking about maybe putting in investment capital into a business. And so what we've been talking about here is this process of companies, and we'll focus right now on publicly held businesses, these larger businesses that are going out to the general public, trying to access capital by borrowing it or issuing their stock or ownership. And they will approach these investors and creditors by giving them information. It is the annual report that contains the general purpose financial statements that investors and creditors can use to hopefully make intelligent decisions. This is what we're focusing on, this capital market. Now, who are the players involved in this by way of review? Well, we've said that the key regulator is the Securities and Exchange Commission. They're a federal regulatory body, and that they are charged with the responsibility of regulating stock and bond transactions between these companies and the public, investors and potential creditors. Not only are they interested in the kind of information that is going to be provided to investors and creditors and have legislative responsibility over that process, but they're also interested in how these stocks and bonds are sold and people that are involved in that sales process. So they are involved in the regulation of the New York Stock Exchange and Bond Exchange and NASDAQ and the people and institutions that are involved in that process, investment banking firms, Goldman Sachs, and provide regulation on how these businesses are involved in that process, regulating stockbrokers and the kind of information, representations that they can make, and information that they can pass along, so that this market not only operates efficiently, but fairly for all of the players involved. Another federal agency that's they're not really involved in this process, but they do affect publicly held companies, is, my favorite regulatory body, the Internal Revenue Service. Their responsibility is to collect income taxes from these companies. There are some other federal regulatory bodies that may be interested in publicly held companies and may want information from those publicly held companies. The Federal Trade Commission has some regulatory authority in the area of trade, and federal communications commissions. And so there may be other regulatory bodies of the federal government that may need information. But what we're focusing on here is stock and bond transactions with investors and creditors, the raising of capital for business. Now, there are, as we've suggested, some private organizations that are actually involved in this process, or at least have some influence in that process. One is the AICPA, the American Institute of Certified Public Accountants. Again, they were originally assigned the responsibility of determining the generally accepted accounting principles that would govern the kind of information to be provided to investors and creditors, but they no longer have that responsibility. However, the AICPA is still involved indirectly because they are involved in the licensing and certification of CPAs. Now, CPAs are certified state by state. It is the state board of CPAs in a particular state that actually gives the certification for someone to act in the capacity of a CPA. And usually those state boards require that there be a certain amount of college education, that the candidate for the CPA certificate pass an exam, and that they have some kind of apprenticeship, some practical experience before, in fact, they're authorized to perform audits of publicly held companies. The AICPA's involvement in this process of certification is it's the AICPA that conducts and provides the CPA exam, by which all states use that exam in order to make some evaluation of competency and knowledge in the profession. The AICPA is also involved because they are the organization that establishes currently the rules of how to conduct an audit and actually does some monitoring of the professional conduct of CPAs as they exercise their responsibility in the audit of public companies. The other private organization that does have some significant influence in this process of providing quality information to investors and creditors for their capital decisions is the FASB. Their responsibility is the creation of generally accepted accounting principles. And again, they do come under the influence of the SEC, but they are the ones now who are charged with determining GAAP. What is a business? And talking about different kinds of businesses, manufacturing versus merchandising versus service businesses, or some combination of those three. And we've talked about how any one of these businesses, in order for it truly to be successful, it would need a really good idea. They'd probably need some capital and some management skill. And we've mentioned that, in fact, maybe the most important thing, or at least the most difficult thing to access for a successful business is, in fact, capital. And we've emphasized that there are really only two ways that a business can access capital. You can either borrow it, or you can get it from the owners, or, in other words, the investors. Now, investors and creditors need information in making their capital investment decisions. It's financial accounting that seeks to provide the financial statements for investor and creditor use in those decisions. Useful financial statements to investors and creditors must have the elements of comparability and credibility. Generally accepted accounting principles established by the FASB provide the key to comparable financial statements among differing companies. These generally accepted accounting principles are the rules that govern what information is going to be provided to investors and creditors, in what format it's going to be presented, and how the transactions of the business are actually going to be accounted for and then reflected on those financial statements. It's also critical that those financial statements be materially accurate. This is accomplished, hopefully, through CPA, Certified Public Accounting Firm audits. They're required by the SEC for publicly held companies that seek to ensure the financial statement credibility of publicly held companies.